Welcome to the Coin Bureau Weekly Crypto Review. Here are this week's top headlines in the crypto news. Cuba embraces cryptocurrency. The isolated island nation has officially sanctioned crypto payments. How Cuba's approach compares to El Salvador's and how this could fast-track crypto adoption in other countries. Cardano smart contracts come at last. The highly anticipated Alonzo hard fork puts Cardano in the ring with other smart contract cryptocurrencies. But where are the dApps? Haste makes waste. Solana and Ethereum's Arbitrum scaling solution go offline. What happened and what effect did it have on both projects? Crypto payment hype, but not all of it was right. Walmart corrects the record on its supposed Litecoin adoption, while AMC announces it will be adding support for Ethereum and Litecoin payments. Who made this fake news and why? Ransomware, beware. The US Treasury Department is reportedly set to crack down on cryptocurrency transactions related to hacks and scams. Here's what they could be planning and when the crackdown could come. Regulators ready to destroy DeFi. Stablecoins, lending and borrowing platforms, and a hidden anti-crypto provision in the upcoming infrastructure bill. Everything you need to know. Institutional demand for crypto continues to grow. Exchange outflows reach record levels as big names and big brands shell out billions for coins, tokens, and Coinbase debt. Could this protect the crypto space in the face of macro threats? And a closer look at what comes next in this week's Crypto Market Forecast. All this and more in just a moment. Good morning, afternoon, or evening. Thank you for tuning in. My name is Guy, and what you're about to see is educational content, not financial advice. You can find any topics you're looking for using the timestamps in the video timeline. And now for today's top stories. Last Thursday, Cuba delivered on its August promise to permit cryptocurrency use in commercial payments. Like El Salvador, Cuba put this law in place to facilitate the flow of money in and out of the country and to reduce its reliance on the US dollar. In contrast to El Salvador, Cuba has not made any cryptocurrency legal tender, nor has it put any laws in place which mandate institutions to accept BTC as payment. The Cuban government has also not provided any cryptocurrency infrastructure. All it has done is set out the laws and regulations crypto-accepting companies must abide by. Conversely, El Salvador has been actively involved in rolling out the rails for its second national currency and has even developed a Bitcoin wallet of its own for its citizens to use. These radically different approaches to cryptocurrency adoption conveniently constitute the perfect test to determine which approach works best. Better yet, it will help stress test the real-world effects of crypto-specific regulations. This is something that other dollar-dependent countries will be watching closely in the coming months and years, especially since some of them, such as Paraguay, seem to be moving closer to full-scale crypto adoption. Now, although crypto adoption has historically centered around Bitcoin, it's only a matter of time before some smart contract cryptocurrencies are named as the next innovation solutions being adopted by governments. Some cryptocurrencies have already managed to clinch these highly coveted government contracts, and one of them is Cardano, which introduced some exciting contracts of its own late last Sunday. Now, many of you were asking why I didn't cover Cardano's smart contract functionality in last week's crypto review. And this is simply because I wanted to wait until the dust had settled before analyzing the effect. Although Cardano has deployed hundreds, if not thousands, of smart contracts over the last 7 days, none of the dApps related to these smart contracts are available to use for the time being. As I mentioned in my recent video about the top projects building on Cardano, this is basically because Cardano developers know that their dApps will break under the burden of Cardano's 1.6 million users. This is reasonable because even a regular website would have a hard time handling that amount of traffic. Cardano's innovative EUTXO transaction model only adds to the complexity of effective scaling. Now, luckily, Cardano's scaling solution called Hydra is already in the works, and a tentative timeline for when we could see Hydra go live can be teased out of a blog post by IOHK late last week. Quote, In the short term, we will keep developing the Hydra node and the Hydra head protocol until it becomes a solid and stable foundation for the community and us to build real-world applications. And, quote, in the medium term, say 6 to 12 months, progress will greatly depend on the results of our research and experimentation, plus feedback from the developer community. Given this information, it's likely that we will not see Hydra on Cardano anytime soon. Even so, it is wise to take your time developing a multi-billion-dollar blockchain, and this is something that some other projects have not been very mindful of in their own development. This is a not-so-subtle reference to Solana, whose blockchain went down for the second time since its mainnet launch last March. The cause of this collapse seems to have been a denial of service or DDoS attack consisting of over 400,000 transactions which were submitted to the Solana blockchain at the same time. The price of Sol tanked in response to the chain halt, but began recovering after Solana developers resolved the issue nearly a day later. As I mentioned in my recent Solana tutorial, the Solana blockchain is still technically in beta, which might be why the sentiment around the incident was not as severe as some expected. The same is true for Arbitrum, a recently released Layer 2 scaling solution for Ethereum, which went dark on the same day as Solana. The cause of Arbitrum's pause was also the same. Someone submitted an insane number of transactions all at once, causing its sequencing mechanism to crash. Now, it's worth pointing out that Arbitrum itself remained online, though Arbitrum devs have warned that this specific issue could happen again in the coming weeks. Despite this concerning comment and the fact that Arbitrum is technically in beta, its optimistic rollups have amassed almost $3 billion in total value locked since they launched on September the 1st. If you want to know why, you can learn more about Ethereum's leading Layer 2 scaling solutions by watching my video about that using the link in the top right. What makes Solana's and Arbitrum's recent issues particularly interesting is that someone tried attacking the Ethereum blockchain itself at the same time. As explained by Ethereum developer Marius van der Weyden on Twitter, an unknown entity suddenly published a long chain of invalid blocks to try and break the Ethereum blockchain. Without getting too technical, this malicious miner was basically hoping that the rest of the Ethereum miners would mistakenly begin building blocks on top of their chain. This would invalidate all the transactions in the corresponding blocks in the original chain, wreaking havoc for both users and developers. Thankfully, this didn't happen, but the coordination of these three attacks suggests there might have been a bigger plan at play here. Now, anyone can guess as to who's holding the puppet strings, but it's clear that they're no friend to cryptocurrency, assuming, of course, that all of these events can be traced to the same source. Speaking of strange events, another event that happened last week was the now debunked press release about Walmart accepting Litecoin payments. Though there were many raised eyebrows at the outset, LTC managed to pump by nearly 30% within minutes, taking the rest of the crypto space on a similar ride to the upside. In fairness, it was a fairly believable announcement given that Walmart is currently exploring cryptocurrency technologies, and crypto payments are a part of that roadmap. Funnily enough, cinema chain AMC announced it would be supporting Ethereum and Litecoin payments less than 2 days later, something which was expected given AMC's earlier announcement about Bitcoin payments. Unfortunately, AMC's announcement didn't have nearly the same effect on the crypto market as the fake Walmart announcement, but it's possible we will see a pump once AMC's new payment methods are put into place towards the end of the year. As I mentioned on my Instagram page, the reason why companies are accepting crypto payments is likely because they're looking for ways to plug the holes in their pockets created by the pandemic. This extra revenue is something that global corporations like Walmart and Amazon don't really need at this point in time, hence why they're taking their time with their own crypto aspirations. In any case, the question remains, who put out the phony press release and why would they even bother, given that Walmart would immediately come out and set the record straight? What's more is that Walmart is now working with law enforcement to find the face behind this farce, and I reckon that was also a pretty predictable outcome of this ploy. While it's likely that this was the doing of a Litecoin troll, it's possible that someone wanted to test the liquidity of the crypto market. In other words, they wanted to see just how much cryptocurrencies would pump in reaction to an announcement like that? Well, if that's the case, they've got their answer. Prices are extremely volatile, primarily due to low exchange balances of core cryptocurrencies. This means that the next time an announcement like that comes around that's actually real, it'll be a clean shot to the moon for the whole crypto market. The caveat here is that this increased volatility means any significantly negative event could cause a massive crash in the crypto market, and one of these events seems to be scheduled for this week. If you watched last week's crypto review, you'll remember that I briefly highlighted the return of the REvil ransomware group and how this could be used as grounds for a crypto crackdown. It looks like I was right, but this crackdown could happen a lot sooner than even I anticipated. According to the Wall Street Journal, the US Department of the Treasury is going to introduce sanctions related to ransomware payments as soon as this week. Because cryptocurrency payments obviously can't be stopped, the Treasury Department will focus on points of entry or exit, aka cryptocurrency exchanges and other fiat-to-crypto payment gateways. The Treasury Department is also expected to pursue any individuals or institutions developing privacy-preserving technologies such as cryptocurrency mixers. Now, I couldn't help but notice a line in the article which reads, quote, "Later this year, expected new anti-money laundering and terror finance rules will seek to limit the use of cryptocurrency as a payment mechanism in ransomware attacks and other illicit activities." Now, I reckon this is a reference to the Financial Action Task Force's recommendations around cryptocurrency regulations, which will be revealed sometime in October. If what I just said flew over your head, you need to watch my video about the FATF's plans to kill crypto, and you can find it using the link up there in the top right. Anyways, to my understanding, it looks like the Treasury Department will tell cryptocurrency exchanges to freeze any funds coming from hacker, scammer, mixer, or darknet marketplace-related transactions. Some cryptocurrency exchanges like Coinbase already do this, but the Treasury Department will probably introduce fines to make sure they're being extra vigilant. The slippery slope here is that US regulators could start blacklisting cryptocurrency addresses belonging to dissidents and defectors, something which is unfortunately within the realms of possibility. Not only that, but it looks like Telegram could potentially get caught up in the crossfire. This was not mentioned by the Wall Street Journal article, but I have seen a few concerning headlines over the last few days which imply that Telegram is where a great deal of criminal communication is taking place. Apple was also sued earlier this year for not removing Telegram from its App Store because the messaging app hosts, quote, hateful content. I suppose this particular group of people missed the memo about all the stuff circulating on Facebook, but that's a topic for another time. The Treasury Department's incoming crackdown is just one of many we could see this week, and one that's been at the forefront of people's minds is the crackdown on stablecoins. The so-called President's Working Group for Financial Markets is expected to issue recommendations for stablecoin regulations in the coming days. Now, the contents of the document are not yet known, but most are expecting Tether to be at the top of the list of concerns it will contain. As I mentioned before, Circle, Paxos, and other stablecoin issuers based in the United States will likely be brought under control of the Treasury Department and possibly also the Federal Reserve. This ties into the new trend of regulators going after crypto lending and borrowing services, and the latest target is Celsius. The lender that regulators warned last week was Coinbase, which pushed back against the ridiculous response it got from the SEC when it asked for clarity about why it couldn't offer stablecoin lending services. Recent comments by SEC Chairman Gary Gensler suggests it's going to bite back by saying some of the cryptocurrencies currently listed on Coinbase are securities. This means Coinbase could face fines for non-compliance, and those coins and/or tokens could see delistings, all in the name of investor protection. No names were mentioned in Gary's crypto comments, but you can get a sense of which ones are at risk by familiarizing yourself with the SEC's views on cryptocurrency. And that info is up there in the top right. Now, if all of this wasn't concerning enough, another anti-crypto provision was recently discovered in the upcoming infrastructure bill, which could be passed as soon as September the 27th. In a nutshell, this provision requires Americans to report the counterparty in every single cryptocurrency transaction worth more than $10,000. This is obviously impossible to do because not all wallets are people. Some are smart contracts belonging to decentralized applications, for example. If you're wondering how the hell this was missed the first time around, it's because the infrastructure bill is over 2,700 pages long, and the second provision was buried deep in the text. On the bright side, some legal experts believe cryptocurrency transactions will be exempt from this provision because the absence of a third party means a warrant would be required to collect information about crypto transactions above 10 grand. Now, it should go without saying that I'm not a lawyer nor a tax expert, and at the end of the day, the way these rules are applied will likely be up to the discretion of regulators, so there's no way of predicting what effect they will have, if any. As much as the crypto market looks like it's about to get wrecked, institutional investors are buying in more than ever before, suggesting everything I just said is nothing more than funny money-funded FUD. For starters, we have record outflows of BTC and ETH from cryptocurrency exchanges, creating the sort of volatile conditions I mentioned earlier. This means investors are buying and holding, not selling. Next, we have the percentage of BTC held by whales, which is starting to climb again. Then we have Shark Tank multimillionaire Kevin O'Leary saying he's doubling his exposure to crypto after calling Bitcoin, quote, garbage back in 2019. You also have MicroStrategy blowing another $240 million on Bitcoin, which you could argue is just another week in crypto. Now, what you don't see every day, though, is Coinbase raising $1.5 billion by selling corporate debt in a matter of days, subsequently raising the amount to $2 billion after seeing $7 billion worth of demand from big investors. Fidelity has also apparently pulled the SEC aside and pressured it to pass a crypto-backed Bitcoin ETF. Meanwhile, ARK Invest decided it had had enough of waiting and is now getting exposure to Canadian Bitcoin and Ethereum ETFs backed by crypto. And to top it all off, you have JP Morgan reporting that institutional interest in DeFi is at an all-time high, and Coinbase execs saying that institutions are starting to eye altcoins too. Forget the regulations. This investment activity is crazy in the context of everything going on at the macro scale, such as the looming Evergrande debt default, which could cause another financial crisis. The TLDR on that one is that Evergrande owes over $300 billion in dollar-denominated debt, which it can't pay back. This is a problem because there are dozens, if not hundreds, of individuals and institutions who lent to Evergrande who are also in debt and need Evergrande's interest payments to pay back their own dues. If Evergrande defaults, the next over-leveraged party in line gets wrecked, and so on until the whole economy crashes. This is unless the Chinese central bank bails Evergrande out, something that history would not suggest. I talked a bit more about the impact of an Evergrande default in my Telegram channel, which I've linked to below. Now, apparently, this is all FUD too, because record amounts of cash were thrown into the stock market by investors last week after it was revealed that the second human infrastructure bill would not include a provision doubling capital gains taxes on high-income earnings. Don't celebrate just yet, however. I'll be covering Evergrande in depth later this week, so don't make any major moves until you've got the whole story. Turning to the charts now, we can see that Bitcoin finally formed that golden cross everyone was waiting for. This means we're likely headed for new all-time highs in the long term, and the key words there are long term. As pointed out by Benjamin Cowan in a recent video, Bitcoin has dumped following a golden cross in the past, and given all the insane uncertainty and volatility we see now, the same could happen in the short term. It really feels like the crypto market is waiting for the calm before the storm, and I quite honestly have no idea whether the wind will blow up or down. If the wind blows down, we should catch support around the 44k range, and if that fails to hold, the next zone is around 39k. If the wind blows up, we could rally back to the 53k range before being knocked back down, potentially blasting through if the reason for the rally is big enough. Keep both scenarios in mind this week because what Bitcoin does will influence what your favorite altcoins do. And this brings me to this week's winners, and these are Cosmos, Ren, Avalanche, Audius, and Curve Finance. Atom's meteoric rise is something I detailed in my recent video about the project, which you can find in the description. In short, Cosmos is starting to build out its ecosystem, and it is growing fast. In terms of how high Atom could go in the next week or so, assuming we see a healthy pullback and a move back to the upside, it looks like $48 would be the next of hopefully many new all-time highs. Full disclosure, I hold Atom, in case you couldn't tell. Moving on though, when it comes to Ren, those who hold it will know that the value of the token is highly correlated to the total value locked in its protocol, and this is something that has grown exponentially in recent weeks. The sad part is that technical analysis doesn't really help here, so there's no forecasting whether Ren will continue rallying. Given the continued restrictions on centralized crypto exchanges, my guess is yes. When it comes to Avalanche, the spark that lit the flame is a $230 million investment into Avalanche's ecosystem by big-name VCs. This has added fuel to the inferno of AVAX's ongoing rally, which continues to take it to new all-time highs. As with Atom, I'm hoping to see some consolidation moving into the mid-80s sometime over the next few weeks. Audio, on the other hand, is a crypto that I don't see going much higher unless some more bullish news magically crawls out of the woodwork. Last time, it was Audius's partnership with TikTok, and this time it was a $5 million investment by some big-name musicians. This news comes at the perfect time, given that Audio's next big vesting cliff comes at the end of the month, and historically, this has dragged down its price quite badly. That said, Audius is an admittedly cool project that should have some serious potential, and you can get my full take by following the link in the top right. Finally, we have Curve Finance's CRV token, which is pumping on the news of a phantom deployment. As a DeFi token, CRV doesn't have the best tokenomics, to say the least, which is why it's best to follow the advice of Phantom architect and Yearn Finance founder André Cronje, and that's, quote, "Don't buy it, earn it." And that's all for today's Coin Bureau Weekly Crypto Review. If you enjoyed it, you know what to do. Hit that like button, subscribe button, and bell icon too. If you want more of me, head on over to Twitter, TikTok, and Instagram to get a sneak peek behind the scenes. If you join my Telegram channel, you'll get the daily crypto updates you crave, and signing up for my weekly newsletter is a great way to get the tools, tips, and tricks you need to get paid. And of course, you can support the channel by heading over to the Coin Bureau merch store and picking up a shirt or hoodie, or both. Links to all these resources are in the description. Thank you so much for watching, and I'll see you all in next week's episode.